But now it's time to welcome our first guest, Peter Tchir. He's the head of macro strategy at Academy Securities. Peter has an extensive background as a structurer and trader at large banks and hedge funds. He's also a regular on networks like CNBC and Bloomberg TV. Peter, welcome back to the show.
Thanks again for having me.
You know, we were talking off the air for just a minute about debt. One of our top 10 things, of course, actually number one. And that's a big thing of yours. Do you want to talk to our income generation viewers for just a minute about why controlling debt on your way into retirement you think is so incredibly important?
Yeah, I think people spend a little bit too much time thinking about what dividend yield they're going to get, what interest rate they can get on what mutual fund, and they don't spend enough time on their debt. So one, I completely agree that paying it down is good, but people should also be looking for opportunities to refinance. A couple years ago, you could have locked in much lower mortgage rates if you had a mortgage. You should have done that. It kind of moved away. It might be coming again. So I would not ignore kind of what I call the liability side of your balance sheet. So where you own debt, not just looking at repaying it, which I think is brilliant, but even if you can't repay it, are there times to refinance? Are there ways to manage that better? And that will help your overall income because you care about the bottom line, not just the income side of your statement.
So in a word, it sounds like most people are focused more on offense than defense. They focus on growing their net worth than they do on reducing their expenses. But isn't that kind of sort of what the federal government's doing right now? You know, this whole thing, doesn't matter how much debt we have, we can grow ourselves out of the debt. We can grow our way out of it as long as we get 4% GDP growth. So in some ways, isn't the federal government teaching this bad habit to our viewers?
Yeah, we, I think, are definitely learning bad habits from our own government. It's a little bit scary how blasé they've become about the amount of debt they're taking on. So when I go and talk to large corporations, 2 years ago, really people weren't talking about the federal deficit. It was viewed as temporary, that it was getting under control. That is now a regular question. What are we going to do with these trillions of dollars of debt that are expanding rapidly? Interest rates are rising. I don't see it as being a big problem for investors yet, but this is something, if we don't start gaining control, I think it's going to, you run that risk of kind of spiraling out of control where our own debt problem is an issue. And it's so weird because we are looking at Europe, who's gone this method of austerity and is getting their debt situation under control, and they're looking at us wondering what the heck are we doing, taking on so much debt, and it's unclear that we're getting enough benefit from it or that we're using that debt wisely. It's not like we were in the middle of a recession. We took on a lot of this additional debt where times were generally good. That could punish us down the road. It's not an issue today for me or for next year, but it's something we've got to keep in mind if we keep heading down that path.
Yeah, you know, the whole government shutdown, I wasn't necessarily opposed to it. I was just questioning the reason. To me, it's not about the wall. To me, the government shutdown should be more about getting the budget balanced, that we can't keep spending, spending, and spending. We reopen when we get everything balanced and figured out. But I guess my question I'd like to ask you, though, is what happens if they don't figure it out? You know, what happens if the debt keeps growing and growing and growing? Could we... You know, right now we have the privilege of being the world's reserve currency, you know, oil being traded in dollars. What happens if something changes there? You know, could we become the next Greece, essentially?
I don't know that we can become the next Greece, but I think we could become the next UK or, England, which really is no longer a leader. And that happens for a couple reasons. One is when I look at DC, their idea of compromise is you get to spend what you want and I get to spend what I want, so we both get to spend. And that's been going on and on. Every time we hit a debt ceiling or some need to compromise, both sides get it. I think we've created a system where everyone's incentivized to spend, try and get as many votes as they can and stay in power, and that's created it. And just like you said, the dollar as a reserve currency is important. They have now started trading, though, in China, oil in renminbi. So China is starting to get global commodities traded in their own currency. I think it's a mistake that we are pulling back from the global stage too quickly. We're letting places like Venezuela into the hands of India, most of Africa into the hands of China. We're pulling back. As we lose that reserve currency status, I think there's going to be a lot of impacts to us, and it's not going to be healthy.
So 30 seconds we have left in this segment. Why can't we become the next Greece if we lose our status as the world reserve currency? Worst case, why couldn't it happen?
Because right now, still so much of the debt is owned domestically. So I think if we could get some inflation, we would look probably much more like a Italy or Spain, which isn't necessarily great, but it's a long way from being Greece. So I think that's what we have. We've got much more protection. And then the other thing, again, we always talk about both sides of the balance sheet. We do have a lot of debt. We have a lot of assets that have not been unlocked, that are national assets, that things can be done to do that. So again, I don't think we have to be alarmist, but we have to start being careful.
Got it. Peter, stick around. We'll be back in just a minute. And you stay with us too. We'll be back with more here on The Income Generation. I'm David Scranton. Right now, let's welcome back Peter Tchir, Head of Macro Strategy at Academy Securities. Peter, thanks for sticking around. You know,
Thanks for having me still around.
You mentioned Italy and some other countries like that. You know, it always amazed me how the Federal Reserve expected our long-term bond yields, our 10-year Treasury rate, to keep going up when our 10-year Treasury rate was already paying more interest than the rate on a 10-year Italian bond, which arguably has a lot more default risk than ours. As you know, the bond market just put its foot down in December and refused to cooperate. And finally, just this last week, Jerome Powell came out with that more dovish tone. And it's possible now that instead of raising rates 3 or 4 times this year, he may not raise rates at all. So is this too little, too late to keep the economy going, to fend off that next recession? Is it too little, too late to fend off the bear market? Or do you think that he came up with this announcement just in the nick of time?
I think he's a little bit late. We really think that they should have started hiking rates much earlier than they did, but much slower. The things that scare me when I look at the impact of rate hikes is things like automobile sales have slowed, and that's dependent on financing. Homes have slowed. So I think they went way too quickly. I think you're supposed to wait 6 to 9 months between a rate hike to make sure that the economy is doing okay. People argue rates are still low, but it's that rate of change that's important. So I think they went too fast. They're shrinking the balance sheet. This is a good pause. They should have started doing this back in September. We've got to see whether collateral damage is done or not. The two things that can help us is getting the government shutdown properly solved would help a lot, and a trade deal with China. If we can get that accomplished, that puts some of this fears behind us, right? If we get a trade deal, we don't have to worry so much about the level of rates. Without that, though, I do think they went too far, too fast, and we're experiencing those problems. So they've got to ease off the brakes, and he finally did what he should have done several months ago.
Yeah, we didn't have time to digest the rate increases, what it comes down to. And, you know, the Italians know best. When they have that big meal on a Sunday afternoon, it might be 8 courses, but it's over the course of 6 hours. It gives you time to digest each course, and unfortunately, the Federal Reserve didn't get us to do that. So 20
That's
seconds.
a great way of looking at it.
20 seconds. Recession. We're overdue for a recession. Do you think we see it at the end of this year? Do you think we see it next year? Or do you think we see it 2021 and beyond?
I think it's beyond that. I think we are going to get the government shutdown resolved, which will help a lot of things. Then I do expect a trade deal with China. It's in China's interest to give us a trade deal. We want it. It will help businesses like liquid natural gas, where we can now export that. We're a great producer of that. So I don't think we really see a recession. We see continued growth, but different sectors are going to lead the way for the next 2 or 3 years. So I'm actually optimistic, but a lot hinges on getting those trade deals.
15 seconds then. How does that leave the stock market? Will the stock market be able to rebound and break new record highs in light of this, or has it gone up so much that, again, that needs time to digest what's happened?
No, I think the stock market can do well. And one thing I really like is companies are starting to pay attention to the debt they've created. So some of the companies like GE, Budweiser, Newell Rubbermaid, household names where the stock had beaten down because they had too much debt, are taking care of the debt and the stocks are rebounding. That to me is healthy and more sustainable.
Got it. Okay, I love the optimism. I hope you're right. Peter, thanks so much for joining us. Stick with us. We'll be right back with more here on The Income Generation. I'm David Scranton. We'll be right back.